Something that you are hearing in the minority on the Fed.
The good news here for the leadership of Kevin Walsh, early days, quick reaction. The dissent came from the regional Fed presidents and not from the board. Because if it came from one of the board members this afternoon, I think we'd be having a very different conversation, TK, to the one we're about to have.
Is the market voting? Apple, $5.053 trillion, just out to a new record high, 344. Is the market voting here on their new Fed
I think
chairman?
Apple's voting on a lack of capex, and I think that's been a story on Apple.
Oh, yeah, I know that. I mean, I get that run. But, I mean, right here within the minutes after this announcement with the SPX popping up is well. I mean, they certainly like what they saw.
Well, let's take a step back and think about what's been happening in asset classes. We've had this massive move higher in energy and lots of volatility in between over the previous 5 months. You've seen that ripple through interest rates. We've priced out cuts and in many places priced in hikes and in some places actually engineered rate hikes. What we haven't seen is a growth scare. The backdrop for growth is still pretty good. Consensus for GDP is still around 2. Unemployment's been falling closer to 4 and away from 5. That's good news. Now you've got a Federal Reserve that doesn't still see a reason, even with that as your backdrop. They don't see a reason to hike interest rates right now today. Some do, but not the committee as a whole. If you're looking at that from a risk asset standpoint, Tom, that's risk positive without a doubt.
It is. I mean, they're moving forward, and to me, the key thing after Jackson Hole is to get to that next meeting. All of a sudden, Jackson Hole may be interesting.
Oh, I definitely think it's going to be interesting. We need to hear about insights from task forces. That said, right now, I do think
you know how much I love the task force.
I think that they're going to be important. To me, this is actually a fascinating statement. Does he set up a September rate hike with the idea that there are 3 dissents and potentially there is another CPI and PPI print that will be potentially hotter than expected?
Neil Dutta Ranmack, always early to publish. He says the following: I think the dissents tell you the direction of travel. It will be very tough for Walsh to hold the line into September. I hope Mike McKee's holding the line just before he goes into that news conference in about 25 minutes' time. Mike, given the lack of new information here, beyond just the dissent, what's your approach to the news conference at 2:30 Eastern Time?
Well, I think we have to ask very direct questions of the chair. We can't ask him broad questions like, what is your reaction function or something like that, because then he's going to just elide those questions and we won't get good answers. So we'll have to pick out some things like where we are with rates. Are those sufficient at this point? Something to try to get him to give us some specifics on how he's thinking. But I think what you guys have just gone through is what he's looking for. He'd rather have you speculating, markets speculating, than give you a hint. And nature abhors a vacuum, so the markets are going to fill it with what they think might happen. But it's going to be hard for anybody to really know unless Walsh wants to start tipping his hand, which it'll be a battle between us and him, I guess.
Looking forward to it, Mike. Thank you, buddy. Get inside that news conference. Mike McKee will go into that news conference for us. It will begin at about 25 minutes' time. If you're just joining the programme, welcome to the programme. So unchanged to the Federal Reserve, but the vote is different. It's 9-3, and the dissenting voices are as follows. Bottom of the statement, Beth Hammock, Neil Kashkari, Laurie Logan. Dissent coming from the obvious places. All 3 of those voting for an interest rate hike. At the bottom of the statement, that line sticks. The committee will deliver price stability. We've got Bob Michael of JP Morgan Asset Management alongside us. Bob, is that line in the statement enough for us not to question their commitment to price stability with inflation running above target for as long as it has been running above target?
I think the 3 dissents are more important than that last statement. I think that it shows that they're starting to migrate towards tightening policy. You know, there's still 75% of the voting members that were in favor of no change. So you're only at 25%, but I think it's important. If I were at the press conference, I'd ask about quantitative tightening. Are they talking about that? Is that something they could start up again and help snug the liquidity that's in the system?
Best guess for September. Limited additional information, but best guess for September. What would you call now?
They do nothing, but maybe there are 4 dissents.
Well, Michael is going to stick with us. Going into that news conference 25 minutes away. Joining us now is Jim Bianco of Bianco Research. Jim, welcome to the programme. It's a whole new world, a new era for this central bank. You've been writing about it extensively. Just first of all, your reaction to this decision this afternoon.
Not surprised by the decision that the Fed did not raise rates. I still would defer with Bob and think that they are going to raise rates in September. I think the dissents are the most important thing, because one of the things I've been emphasizing is after Trump attacking this Fed for 2 years, they want to be independent. And they've decided that independence is 12 independent voters. So what we're going to get at the press conference is 1/12 of the opinion of the Fed is we're going to get Warsh, or maybe we won't get it at all if he doesn't express it. Now, he's got a lot of power. He could probably, twist some arms to get them over the line, whichever way he wants to go. I suspect that if they were all voting their true conscience, we might have had a few more dissents, maybe not enough to raise rates, but a few deferred because he didn't want to do it, would be my guess.
Jim, do you think it's significant that none of the governors joined with the dissenters, even though there were some reports of some pretty interesting family fights over dinner last month?
Mildly. I was expecting that maybe Chris Waller was going to be a dissenter. He still might be a voter for a rate hike in September, maybe a couple of others. But I do want to emphasize again, we're going to parse every word that Warsh wants to say. I think that the Fed is more of a vote tallying exercise right now. You got to look at all 12 people and say, which columns are they in? High, cold, or cut, and 7 is a majority, and which column has 7, and that's what the Fed's going to do. That's how they work now.
Bob Michael, the young whippersnapper Jim Bianco, a couple years ago had an arch call calling for higher interest rates when no one was looking for it. The other day, Ed Yardeni said, these are normal rates. We have to get used to rates being here again. Is Dr. Yardeni and Jim Bianco correct? We just got to get used to these higher rates?
Yeah, I think what we're seeing more broadly across the economy is a need for CapEx. There's demand for capital. There's a productive use of it. There's going to be competition and a cost of it. That's pre-GFC kind of macro environment. You're not going back to 0 to 2% rates. Do I think there's enough cause for them to hike in September as opposed to next year? I don't think inflation is going to change that much.
I can't remember, John, if you're on here or off here, but you said this 20 minutes ago. What percentage of people in the street actually remember pre-GFC?
We were very live, and I remember what I said. I talked about the average age on the trading floor, which is probably mid-30s right now. So the world that they're used to is not the world that Kevin Warsh wants to take us back to. It's also not the world that we've experienced in financial markets either. To your point, we had these anchors across fixed income for the last 10,
price stability, I'll throw one other into you. Kevin Warsh said that inflation is a choice. They might have to choose to do something about it fairly soon, and maybe as early as the September meeting.
Jim, if they do something about it, do we continue with this robust nominal GDP we've seen?
I think we can. And I also think if the Fed were to raise rates, that might put the high in yields for the year. I think part of the problem has been that now that we don't have forward guidance, the market is pricing what it thinks. And I think it thinks there's an inflation, let's say, issue or worry. I don't want to go full-blown problem or crisis. It's not that bad yet. And that's why yields keep going up. And I think it would like to see the old line, the old adage on Wall Street I've been using is that bond traders can relax or stop panicking when the Fed starts panicking, and maybe a little bit of panic from the Fed might go a long way to helping the bond market stop with this yield rise on the long end.
It's a valid point. Jim, appreciate your time, buddy. As always, Jim Bianco there of Bianco Research. If you're just joining the programme, welcome. A news conference with Chair Warsh in about 17 minutes' time. The decision 13 minutes ago, leaving rates unchanged, a vote of 9-3, 3 dissenting voices, 3 regional Fed presidents, Hammack of Cleveland, Kashgari of Minneapolis and Logan of Dallas. 3 voices who have given us a decent steer that might be the outcome of this meeting, at least for them. Next 2 weeks might be interesting. I think we're all going to look for that schedule, aren't we? Those speeches, what everyone thinks, and this was always the problem for this Fed chair. Looking to put communication back in a box, back in a bottle and throw it away and bury it. Everybody else still wants to talk. And if you speak less, we just put more weight on the people that do speak, and that's what we'll be doing in the coming weeks.
It's going to be a vote tallying exercise over the next 2 weeks with people watching every single press conference, every single speech, and wondering who is going to be the additional voice to vote for a rate hike and how close are they. And that is ultimately the calculus that we're going to see. Kevin Warsh could potentially put that back in the bottle if he gives us some sort of quantification or characterization of what the reaction function is. But barring that, we're going to be doing vote tallying, and we're going to have a bingo card, and it's going to be a lot of fun.
Can we go from 3 to 4 to 5 to 6, etc. to 7? Diane Swank of KPMG joined us now for more. Diane, welcome to the programme. Do you believe this is the direction of travel? This is the first of many votes that will look for higher interest rates?
Absolutely. I think the 3 dissents from the presidents is what exactly we should expect right now. And those dissents were not done in a vacuum. They also are representing presidents who could not vote at this meeting. That is often what is done. And I also think many people on the board are leaning starting to get, this is something that Kevin Warsh has said himself. We've had 5 years of inflation. It's not all the Fed's fault, but at the end of the day, it is the Fed's choice, as Jim pointed out, to do something about it. And we need to do something about this inflation. It has been around for too long and created a muscle memory. It's becoming the norm instead of the anomaly. And tomorrow we're going to get that PCE data, which the reason why Beth Hammack sort of threw down the gauntlet and wrote the LinkedIn post hours before the Fed's blackout period, letting us know exactly how she felt about rates, was because they were tracking the inputs on that number, and it will be 3.3% on the core, and on the super core, I think 3.7% super core services. That is sticky and hot, and hotter than it was at the beginning of the year.
Bob Michael had a really good point earlier. He said it kind of depends why they hike. Is it going to be that the data shows a reacceleration, or is it just that they're running out of patience? And if they're running out of patience and tolerance of high inflation after more than 5 years, that typically isn't a great place for a central banker to be in. Would you agree with that?
I do agree with that to some extent, although I think we still got a little more inflation out there as well. But the problem is that it's just been too persistent. This is too much for too long, and it's compounded. Much like I've argued, compounding stock returns have raised the level of wealth. Compounding inflation has risen the level of prices to be too high for too many. And that being front and center is not the definition of price stability. And that is what the Federal Reserve is charged to do. And with the labor market in a stronger position, there's no reason not to do it now.
Bob Michael, I'm not going to go to the one with sterling academics at Michigan and economics. I'm going to go to the classics major from Pennsylvania. Is it a small matter that the 3 dissenters are an aerospace engineer, educated, a public policy, Lori Logan, educated. And Beth Hammack at 21 was on the desk at Goldman Sachs. Is this almost a dissent rebellion against traditional monetary economics?
It may be more common sense than anything else. I think, as Diane pointed out, you've been a long way away from the 2% target for a long period of time. There could be a little bit of disinflation in the system. I wonder what happens if the next couple prints on core PCE, you go from 3.4 to 3.3 to 3.1, and you see you're still above 2%. But what about on core CPI? You go from 2.6 to 2.5 to 2.3. You're still above 2%. I think dissents reflect that, hey, we're not at our target. If this swings around the other way, we're poised to move, but you don't move yet if you're starting to see some disinflation.
Can you talk about Goldman, the Death Star in front of JP Morgan? Can we do that?
No, but that's where Beth was. She was 21 years old on the desk, and nobody dissenting, John, did the usual economic path.
Let's go to that Hammack
find that
dissent.
remarkable.
Let's go to the quote of hers in the LinkedIn statement going into the quiet period. The lead up to this dissent. There is no conflict in our mandate. Inflation is too high. The labour market is right around my level of maximum employment for the first time in my tenure. I'm hearing from businesses who say they think we need to take action to curb inflation. Diane, that's pretty punchy stuff. And when you said that dissent might be on the behalf of others on the committee who don't get a vote, how many regional Fed presidents are hearing the same thing from their districts across this country?
I think they all are, and I think that's the important, sort of what we're seeing out there. We are seeing many people across the country, and it's showing up in the Beige Book as well. It's showing up out there that firms still have some pipeline even on last year's tariffs. So the new tariffs, they're reinstating old tariffs. That won't add a lot of extra tariffs out there. But we also have Russia sanctions, which allow up to 100% tariffs on some of our trading partners at the discretion of the president. So those are going through Congress right now. All of that is more choke points, more shocks at the same time that we still have this persistent underlying inflation that's just not going away. And to think that it's going to go away on its own when we're seeing things like in the wages in the leisure and hospitality sector, which shed jobs last month, wages actually accelerated. That's something to watch. That's the service sector. That is where we're seeing that buoying sort of effect of wages, also the costs holding up that inflation. That is something the Federal Reserve is very concerned about. You want low-wage workers to get more pay, but only if they get more pay that's above and beyond the level of inflation.
Bob, I'm struck by the neutral rate. We haven't talked about it once, but given the sort of competition for capital that seems to be going on globally, is it possible just that the real rate has to be a whole lot higher than people previously expected? And frankly, we're seeing that in the lack of any kind of erosion from demand?
Remember when the Fed first started doing the dots in 2012 because they didn't think we in the markets were smart enough to know what normal looked like again. So they were going to help us out. And you go to that long-term median dot, which was perfect textbook. It was 4.25%. How did they get there? Over the 100-odd-year history of the Fed, the real Fed funds rate had been 2.25%. What were they targeting? 2%. You put the two together, there's your fancy algorithm, 4.25%. Wouldn't it be funny if that proves to be correct over the next decade?
I look, John, at where we are with this, and again, we got to get to the next meeting. This press conference to me, I mean, to Bob, it's gone out on Twitter, what Bob said about what are we going to see. We have no clue what we're going to see here.
Zero.
Zero.
It's totally up to him.
Will he be on time?
I mentioned to Mike, I hope he will be. I mentioned to Mike earlier on this morning when we were on Bloomberg Surveillance, and I said to Mike, as a journalist, you have to change your questions because no one wants to be the journalist in the news conference that gets a two-word response and it involves task force. No one wants to be that guy. So what are the kind of questions you need to ask Kevin Walsh that maybe you wouldn't have thought of asking Chairman Powell?
Yeah, well, what Mike said was you've got to be very specific. And I liked his question about specifically how are you thinking about oil? Because right now, you could say a lot of the inputs to inflation are supply shocks. How do you consider supply shocks when they are repeated supply shocks again and again and aren't likely to stop being shocks considering the fact that this conflict isn't going away anytime soon?
Dan, you're great at this. Final question. What's your question for the Fed chair? You've talked about a new chair, an old guard. What's your question for this guy?
I guess my question is really on that neutral rate, exactly as Bob outlined. I think we're actually lower than the neutral rate right now, and I think many on the Fed believe that we're lower than the neutral rate, or at least at the neutral rate, which is not where we should be if inflation is at this level.
Dan, appreciate it. Dan Swank there at KPMG. It's such a good point. There's a phrase that you heard a lot, I think, over the previous year or two when they were cutting rates. They talk about being sufficiently restrictive. How many times have you heard that in the last 6 months, being sufficiently restrictive? I haven't heard it at all from a single Fed member.
Because guess what? The evidence doesn't back that up, that they're sufficiently restrictive, because inflation moved in the wrong direction. And increasingly, people are saying that the 3 insurance cuts last year were a mistake, and that actually fueled some of the incredible run-up in some of the memory chip names.
Victoria Fernandez of Crossmark joins us now for more. Victoria, welcome to the programme. Is it time to take back some of the insurance we took out last year with 3 cuts and the year before with interest rate cuts then too?
You know, Jonathan, I actually thought that's why we might actually see a rate hike today, and that was going to be the explanation for it. Not that they were concerned about longer-term inflation. They were going to be looking through the Middle East, through oil, all of that. I think that the concern was going to say, or the explanation was going to be, we're just taking off some of that accommodation from last year that wasn't really necessary. I wouldn't be surprised if that's part of the explanation they use at the September meeting, if they decide to hike then. But I definitely think it's part of that story. It's part of where is neutral rate. It's part of the concept that maybe we are not as restrictive as a lot of people think we are. All of that goes together to tell us we probably have a rate hike coming.
Victoria, you're in the heart of oil land in the United States. You're in Houston, and there's a huge boom going on. I'm looking at the earnings coming from the oil sector, and they're doing wonderfully. It's been both, yes, penalization for some consumers, but on the flip side, it's only adding to some of the robustness that oil prices have gone up to such a degree. How much do you agree with what we've heard from some regional Fed presidents, which is that companies are asking for action as they see both the momentum increase in tandem with prices?
Yeah, you know, Lisa, it's an interesting topic because you always have people when oil prices come down, they want to know why they're not, you know, moving fast enough to bring oil prices down. And yet at the same time, they want to know why these oil companies aren't investing more cash. Why aren't they drilling more? Why aren't they doing more things? And they have to have the free cash flow to do that. And I know their balance sheets are really strong right now. Energy is the best performing sector that we've seen so far this year. So I think there's an element here that the energy companies are really kind of sitting on their hands a little bit because they know that when the Middle East conflict is resolved, they're going to see that drop in prices. Look how quickly we saw prices come down almost, $25, $30 a barrel for Brent and WTI when we had the memorandum of understanding, and we've seen it go back up in the last few days. I do think there's going to be a lot of volatility here. Earnings are actually expected to come down the rest of the year when you're looking at the energy sector. So I would be careful here. They're doing really well right now. I think it's a great long-term holding to have in your portfolio, but I do think the energy companies are going to be a little bit cautious here.
Victoria, look how limited the rally was in bonds when we had that correction in crude. It tells me that the outlook for rates is not that dependent on the path for oil. Is that a fair assumption, a fair conclusion?
I think it's a pretty fair assumption, Jonathan, because actually I think what the bond market is looking at is saying, wait a minute, yes, we have this oil component, and it's making the headline numbers come down quite negatively when we're looking at inflation reports. But the core and the super core, where it's not included, we're actually seeing some still moves higher in those elements. So to me, that's the key question to this Fed. How are we going to measure how much some of these shocks that you want to look through are actually seeping down into the economy as a whole? They say the economy is expanding at a solid pace, but how long if we keep seeing pressures come in at that point? So I think the bond market is more concerned around that, more concerned around deficit spending, around money supply, not so much around oil price changes.
Victoria, it's good to see you. Appreciate your time as always. Victoria Fernandez there of Crossmark weighing in on this Fed decision. Equities this afternoon still negative by 0.5 on the S&P 500. In the bond market, 2s, 10s and 30s shaping up as follows. 2s, yields down just a single basis point right now. 2s around 4.28. Framing matters. These 3 dissents, what is the character of each individual dissent? What will they say in the coming weeks in their statements? Is this about taking back the insurance they took out last year and the year before, or is it more than just that?
Well, they have all indicated about taking back the insurance from last year, and they've all talked about the price pressure that consumers are feeling and that they're hearing even from companies. That said, my question is about the others and who's going to potentially join them at a time of incredibly volatile inflation, and is the volatility in inflation enough to actually get them more concerned that they need to make a move and take a step there?
In defense of Chairman Warsh, we're all going to be waiting on the data now. I mean, the data is incredibly important through Jackson Hole onto the next meeting.
The curious case of this particular meeting, TK, is that we looked at the data and it was softer than expected on CPI and PPI. And there was a feeling that we would move on. And we sat around this table at the time when the data dropped on Bloomberg Surveillance, on Bloomberg TV on that very morning. I sat there with you and we both said the same thing. It removes the urgency to hike. It won't kill the story. The debate continues, and the debate does continue even this afternoon, and now we're talking about September, and maybe September's the date, and this is the direction of travel. The story just won't go away.
Take a look at earnings. Earnings have been on fire, and it's not just in the tech sector. It's across the board. The equal weight's outperforming also because of a fundamental kind of bleed up. And
regional banks in this country.
I mean, really,
it's
something that's more significant. So sufficiently restrictive. If you're looking to crimp growth in any capacity or looking for a slowdown, it's not happening.
Bob, I was going to say final word, but you might be sticking around. I have no idea how long this news conference will be, but give us a final thought on what you'll be looking for through what is not a sleepy summer.
I think the Fed got it right today so far. We'll see if there's a press conference and what gets said or not. I'm particularly glad with the fact that they've listed the 3 dissenters. Let's assume that the vote had been 7-5 in favor of a rate hike. By listing the 5 dissenters, we would know the 7 people who voted for a rate hike, and we'd sit there and go, we got 2 or 3. Where did the other 4 or 5 come from? What were they looking at? They didn't say any of this 2 weeks ago. What changed their mind? Is it all emotion? And I think that's a great regulator to a central bank and prevents them from just acting on emotion.
Bob Michael of JP Morgan Asset Management. Bob, thank you. Might be back with you in 5 or 10 minutes' time. This news conference is about to begin in about 60 seconds from now. A newly minted Fed Chair, Kevin Warsh, will appear for his second press conference, widely criticised last time around. Not for his refusal to offer forward guidance, that's gone, we've moved on, but his refusal to articulate his so-called reaction function. I think 3 dissenters at the Fed have been pretty clear about how they think about the incoming data and where they think policy should be.
I think Mike's question earlier is a really important one. How do you consider oil, and how potentially does the increase in prices affect your view, considering it does tend to be a one-time shock? But when you have rolling shocks, there is another type of dynamic that takes hold, and that is what we've seen.
I'm not a big gambler. In fact, I'm against betting. But I will ask this question. How many trading floors right now do you think are taking bets about how long this news conference will be with Kevin Warsh?
I think that's the question. I think we're taking bets right now because we're trying to figure out for programming reasons who we're going to have to book afterwards.
What's your number?
I think it's going to be 45 minutes.
And seconds, Bramo. 45 and how many seconds?
45 and 32 seconds.
TK, you playing this game?
I'm not playing this game, but
okay,
I can just imagine Kelsey Barrow at JP Morgan with Kay Hare. They're all around the terminals, you know, betting here. They're probably in one of the 14 restaurants.
Kelsey's running the book at JP Morgan.
Yeah, I think she's running the book. They're probably in a bar over at their new skyscraper.
The man himself walks into the room. Kevin Warsh, Fed Chair, in front of the podium following an unchanged decision, but with 3 dissents. Let's take a listen.
My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission-focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting. a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act.